The next thing that we want to examine is the debt to income ratio. This is basically the percentage of your monthly income that goes towards paying off debt. All right, a low debt to income ratio may be considered desirable because it indicates that you have a relatively low level of debt in relation to your income. So banks and loan offering institution would like this in order to extend the courtesy of a loan. The debt to income ratio, or the DTI, is a financial metric as well that comprises a person's monthly debt payment to their monthly gross income. It is used to assess a person's ability to manage their debt and is an important factor in determining their credit worthiness. And we're going to be looking at what the word credit worthiness means when we move down into discussing all things credit. But for now, the DTI ratio is calculated by simple ratio, debt to income ratio. In the name, it gives us what is happening. Ratio, there's going to be a divide, right? So the DTI is calculated by dividing a person's total monthly debt payment by their gross monthly income. So all the money that they make before taxes, that there is the gross income, and then the debt will be above it. For example, the total monthly debt payment for a particular individual is $1,000, and the gross monthly income, that is before tax, is $4,000. Their DTI would be 1,000, the debt is above, and the monthly income is below, which is 4,000. So that is 1,000 over 4,000. That is 1/4. So that there would give us a quarter, and quarter is about 25%. Exactly 25%. Beautiful. So that is how we can computate the debt to income ratio. The debt to income ratio are generally expressed as a percentage because it's a ratio, and 100% would be 1. And they are used by lenders to assess a person's ability to manage their debt. Yes, we currently live in a debt-based society in which we have access to a lot of debt. If debt stops, then the whole system of the scheme that has been created will collapse, and we don't want that. So we have to continue this debt cycle for now until we have a better measure of managing and monitoring our wealth and finances. So lenders generally prefer to see a DTI ratio of 36 or lower. Yes, so that means that 36% of your income, your gross income, can go towards paying off debt. However, the lower it is, the better it is for you, because it means that you have more cash flow and they will be more prone to give you money. You have to realize that the more money you have, the more money finds you. When you need money, it is hard to find money finding you. So you have to understand how the money system works, because everybody sees you as a good candidate. Everybody wants to give you money because they can guarantee that they will be making a return on their investment and it is safer in your hands. So when this is done, you will be extended the courtesy of different lines of credit, different loan facilities, but you have to decide which is best for you. And when this is observed as well, you can also negotiate your rates. Now, a high DTI ratio may indicate that a person is overextending themselves financially and may have difficulty making their debt payment. This makes it more difficult for them to get approved for loans or credit card, or they may even get less favorable loan terms. So this is going to also be based on your credit score, credit valuation as well. So if your debt to income ratio is very high, this is where the predators come in and they say, well, you are unreliable or allegedly unreliable individual, so I am not going to charge you the market rate of 7%. I am going to charge you 50%. And because you are in a bind, and you're in a compromised state, guess what's going to happen? You're going to want to take that 50% because that is the best that you can do under those circumstances. So your credit and credit worthiness are critical, and how you can maintain that and manage that is first understanding your numbers, your income, your expenses, and maintain and regulate your DTI, your debt to income ratio. On the other hand, a lower DTI, debt to income ratio, may indicate that the person has a good handling on their debt and is a responsible borrower. So everybody wants to lend money to this person. This can make it easier for you to get approved for loans and credit cards, and they have more favorable offers. So the market rate is 7%, but because you are a good person based on your debt to income ratio, then you may even get it at a 5%. It is important to manage this debt to income ratio carefully, as it can have a significant impact on your financial health and ability to borrow money. I want you to be in a position where you can go to any bank and borrow as much money as you desire. But first, you have to get your finances in order. So let's just go into a simple methodology of calculating the debt to income ratio. To calculate debt to income ratio, you need to gather all the information about your monthly debt payment and your gross monthly income. Here are the steps that you can follow. First, calculate the total monthly debt payment. Add up all your monthly debt payment, including your mortgage, your rent, if you have a rent, your car loan payment, your credit card payment, your student loan payment, and any other debts that you have. Then you're going to calculate your gross monthly income. If you have 10 different streams of income, you calculate all of those. This includes any amount of money you earn each month before taxes are deducted from it. This includes your salaries, your wages, your commission, your bonus, and any other income that you earn on a regular basis. Then you're going to divide your total monthly debt payment by your gross monthly income. Once you have these numbers divided, your total monthly debt payment by your gross monthly income, this will give you your DTI ratio as a decimal. And then just to convert that decimal, we don't need to do complicated maths. All we're going to be doing is just multiplying whatever it is that we get by 100. So if you got a DTI ratio of 0.3, then you're just going to multiply it by 100, and then that is going to carry it up to 30%. So your DTI would be 30%, which is not excellent, but good enough to be able to receive different loan offers. Say that you have $1,000 in debt payment. Your gross monthly income is $5,000. Your DTI ratio would be 1,000 over the 5,000, which is equal to 0.2. So in order to calculate that now into the percentage, we're going to just multiply that by 100, so that's we get the percentage, which would be 20%. So 1 over 5, 1/5, 20%. So in this example, we are seeing that the DTI of 20% exists, which means that the monthly debt payment of this individual would be equal to 20% of their gross monthly income. So basically, it tells how much of the income is going towards debt payment. It is important to keep in mind that the DTI ratio can vary depending on lenders and the type of loan that you are seeking. Because if you're seeking a housing loan, sometimes they allowed for up to 50% DTI, but that there is a special class of loan. But you have to be very mindful to keep your expenses as low as possible and try to increase your income as best as possible. And there are two ways that you can increase your income. Either you get additional source of income, or you're going to have to change the position that you are in if not able to get increases or raise. So this is where we're going to pause this segment on the Dr. Kareem Ainsley encounter, where we discuss the debt to income ratio, the DTI, and we compared it with the net worth. So now we have a grasp and concept of how to calculate our net worth, which is our total assets minus our total liability. And then we know as well how to calculate our debt to income ratio, which is calculating our total monthly debt payment, and then we're dividing by our gross income, and that gives us our DTI. Thanks for spending some time with us here in this space where we use cents to make dollars. Have yourself a money-filled day. Do the right thing, and don't get caught with your pants down engaging in financial. Until next time, be blessed.